Chapter 6, Saving and Investing. Discussion number 3, Mutual Funds and Bonds. Now, there is a way to invest in stocks without necessarily assuming all the risk. One of the more popular ways to invest in the stock market is the way of a mutual fund. Now, mutual funds are not federally insured, so it's not like you put your money in, you're guaranteed. It is possible to lose money in a mutual fund. But what a mutual fund is essentially a team effort to make money on the stock market. A whole bunch of different people put their money into one basket and they hand it over to a financial manager. That person spends all of their time buying and selling stocks, collecting dividends, and then using that money to hopefully make good purchases on the stock market and increase the amount of money that was in that original pot. And then everyone who's in that mutual fund gets to share in those profits. That's what a mutual fund is. Now, there's also money market funds, which are used by banks and businesses. They sell their debt. In other words, give us money, we'll give you a certificate saying that we'll pay you back with interest. And then the buying and selling of this paper, that's what it's called, of the short-term debt of businesses, is how people can invest, and it's another way to make money in investing. Now, there's another way called bonds. Now, bonds are essentially a certificate of a loan to a company with the promise that they're going to pay you back in the same way that when you borrow money from a bank, that you promise you're going to pay them back. The big difference is that when you buy a bond from a corporation, you're not buying part of the company like if you were buying a stock. There's a benefit, though, that if the company goes bankrupt, you get paid off before an owner does of a stock. Also, there's tax-exempt bonds where local municipalities, for example, you could say the borough of Chambersburg or Franklin County, they decide that they need to borrow money in order to build a new courthouse or to build a bridge, and they need the bridge now, but they don't have the funds right now. They can sell a bond to essentially float a loan from the public so that they can get the cash now, build the bridge now. One thing that makes these a little bit more likable for investors is simply because if it's a municipal bond, it's a tax-free bond, and that means that all the interest that you get from that bond cannot be taxed by the federal government, and therefore you're making a little bit more profit than if you were with a corporate bond, because you would have to pay on the capital gain or the interest that you got. Also, savings bonds. Some of you may have had savings bonds bought for you when you were a baby or growing up. The idea is that they would make money and then you could turn them in before college, and by now you could probably buy maybe half a book with all those bonds the way that textbooks cost now. Savings bonds are essentially you're loaning money to the federal government. Something a little bit curious, though, that maybe you may not realize, the savings bonds that everyone buys, they are Series EE. They're actually bought at half the face value. So that means that if you got a $50 savings bond, when it gets to its maturity, which is usually like 20 years, it's supposed to be the face value. The person only paid $25 for that $50 bond. So that's how the federal government makes money now, and then they'll pay it off later. Of course, what usually happens is that they take more loans out to pay off the debt that they already incurred with that savings bond. Another bond term that you may have heard is that of a junk bond. And a junk bond is simply a bond that is where a corporation is asking for a loan, and most people are pretty much saying that that company is a very bad risk and that it's likely that that company may go bankrupt, and therefore you have a chance of not getting your money back. Of course, corporations who are in this situation, who are desperately trying to hold on to survival and asking for a loan, they're going to be offering higher interest rates than what the normal market would be. So people will take a bigger risk by loaning them money with a junk bond, but it's also highly likely that, or not highly likely, but it's possible, much more possible than normal, that they would lose the money when the company might go bankrupt. Other bonds that you can hear about are issued directly by the Department of the Treasury of the United States government. They are taxed federally, but they cannot be taxed locally, so only the federal government would get tax money. States would not be able to tax it, and like the county of Franklin would not be able to tax it, or the borough, or any of the townships. There are 3 different levels of these Treasury certificates. Treasury bills pretty much mature in only about 2 years. Essentially, the only people who play around with this are the investment banks. It's kind of like their form of cash without having a whole bunch of George Washingtons and Lincolns and Ben Franklins and that type of thing. Treasury notes mature in 2 to 10 years, can be held by some investors. And then Treasury bonds generally go 20 to 30 years, and those are also investments. But pretty much the general public is going to be dealing in the savings bonds, not in the Treasury bonds. Now, the bond market pretty much completely in New York City. In fact, the Federal Reserve banker of New York City is responsible to keep track of the Treasury bills, notes, and bonds. And there's also an American exchange bond market, and these are the places that you go that you would be investing in the bills, notes, and bonds. Concludes discussion number 3, mutual funds and bonds. It's part of the Chapter 6, Savings and Investing Notes.